Fannie Mae and Freddie Mac just made history. According to an article by the Wall Street Journal, those two are going to increase the amount that they will back, and it looks like it's going up to almost $1 million. So I wanted to talk about this article that was recently published about Fannie Mae and Freddie Mac by the Wall Street Journal. I also want to discuss what this could mean for the future of the housing market. So today's video will basically be my initial thoughts and my initial reactions to this Wall Street article about Fannie Mae and Freddie Mac increasing their mortgage-backed limits. So let me know if you like videos like this by smashing that thumbs up button below and hitting that notification bell too. That way YouTube shows our videos to way more money minds around the world. We can keep making videos just like this one. The article starts by talking about how these changes are expected to take place sometime in 2022. Fannie Mae and Freddie Mac are going to expand the amount that they will back. Now, expanding is nothing new. We saw them expand the amounts that they'll back in 2010 and in 2020. These two will basically expand their amount whenever home prices start to increase. This is a way for more people to buy homes. Before we continue, I want to give you a little bit of context and background history on Fannie Mae. Essentially, Fannie Mae was started all the way back in the 1930s as part of FDR's New Deal. Fannie Mae made it a lot easier for people to buy houses. This is because they would protect the lender and would back a certain amount and a certain limit on mortgages. Before that time, lenders were not protected by the federal government. So if they were going to lend out money to someone, they had to be absolutely sure that that person was going to pay them back. This made it very difficult for the average person to afford a home because lenders were very strict on who could get a home. Nowadays, it's typical for someone to put around 20% down on a house. That means you're paying 20% of the total cost of the house up front and then mortgaging the remaining 80%. Before the 1930s, though, it was common for people to put down 20, 30, 40, and even 50% down on a home when they were buying it. That meant housing was pretty much reserved for the wealthy, and everyone else was just left with renting. But then the United States government created Fannie Mae. Essentially how the process would work now is that the person would work with the lender or Fannie Mae in order to get a mortgage. Now it's important to note here that Fannie Mae does not actually issue any mortgages. What Fannie Mae does is buy mortgages from lenders. Here's what that means. If you go to get a mortgage, even back in 1930, you would essentially work with the lender. Say the mortgage was for $100,000. Normally, the lender would pay for your house. This is what the mortgage is, and then you would slowly pay back the lender with interest. So they're giving you a loan here. You're basically telling them that you don't have the full funds in order to buy the home, so they will cover the difference, and then you owe them with interest. However, like I said before, this was problematic for lenders because if somebody couldn't afford the mortgage or went under, the lender basically lost all of that money and had to come up with it somehow. This is where Fannie Mae comes in, because now what they will do is buy that mortgage from the lender. So essentially, the lender is paying for your property, and then the lender is then selling that mortgage to Fannie Mae. So what does this mean? Well, it means that the lender now has all of that liquid cash on hand because they lent you $100,000, but then immediately got $100,000 from Fannie Mae. So they're getting $100,000 from Fannie Mae, and then they're eventually going to get all of that money back from you as well. This means that if you can't pay your mortgage, the lender is still protected. They have that government protection up to a certain amount from Fannie Mae and Freddie Mac. And according to this Wall Street Journal article, those limits are currently at around $548,250 in most US markets, and they can go up to around $822,375 in what is considered high-cost markets. But those numbers are going to increase in 2022. The Wall Street Journal reports that the baseline levels are going to increase to $650,000 in 2022, and the high numbers are going to increase to just under $1 million. And like I said, it's not uncommon for Fannie Mae and Freddie Mac to increase the amount that they'll back. as housing prices continue to rise, they're also going to need to raise their limits as well. That way everything is just about equal. If they didn't think about what that would mean, it would mean that a lot less people would have access to loans. That would hurt banks and other financial institutions. And you might be thinking, well, Nate, I don't care about if banks fail. I don't care about these top financial institutions. Well, the problem is you might, because a lot of our money is tied up in these financial institutions. Essentially, when Fannie Mae buys that mortgage loan, it gives that money back to the bank. So let's go back to that $100,000 example. If Fannie Mae gives a bank $100,000, it then uses that cash to give out other loans. It then uses that cash for a variety of other reasons. If banks and other financial institutions ultimately fail, well, then anyone that has a loan or money in a bank is going to suffer because of this. Now, if you just have a bank account, like a checking or a savings account, your money is guaranteed up to a certain amount through FDIC. So there wouldn't be a worry about actually losing any of your hard-earned cash here. But our banking systems in the United States would basically fail, and we wouldn't be able to hold our money in a checking or savings account anymore. Because banks aren't making any money, they can't keep any brick and mortar locations or any online ones either. That would mean some big changes, and you can argue whether this system is good or bad, but that is the current system that we have in the United States. Home prices in the United States rose by 16% in 2020 and are now at around $363,700 on average. That is the largest single year increase that we've seen since 1968. And 2020 and parts of 2021 were a crazy time for the housing market. Essentially, you had the Federal Reserve drop its benchmark interest rates. Interest is how a lender makes money on a loan. Think of it this way. If a lender gave you $100,000 and only asked for that $100,000 back, then all they would ever have is $100,000. So they charge you a certain amount of interest to actually start making money on that loan. Interest rates for mortgages fluctuate over time, and it depends on what your overall credit score is. But just before 2020, the average interest rate was around 5 to maybe 7%. Sure, there were people getting in on interest rates that were lower than that, but some people were also getting interest rates that were much higher than that. It really just depended on a variety of different factors. But in 2020, the Federal Reserve slashed interest rates, and they dropped to nearly zero. This meant that people could get homes that they wouldn't normally be able to afford. So we had millions of people buying houses in 2020, and that led to a housing shortage. That caused housing prices to shoot way up because demand was rising faster than the supply of homes available. Not only that, but people realized that they could make a killing on their house. They could essentially sell their house right now and make a lot more than what it's actually valued at. But it wasn't just interest rates. The Federal Reserve printed trillions of dollars in stimulus last year and in parts of 2021. This gave people a bunch of additional money to put down on a house. Well, before, a lot of people didn't have thousands of extra dollars lying around to put down on a house. But because of all the stimulus, they now did. So last year, Fannie Mae and Freddie Mac increased the amount that they would back. And in 2021, they did it again. And in 2022, they're doing it again. And what you're probably thinking is, so what's the big deal here? More people are able to buy housing. Isn't that a great thing for the economy? Well, yes and no. More people are going to have access to mortgages now. And because the government is backing more, this means that lenders are going to give out lower interest rates. So for one, more people are going to get into debt. Now, they're also going to have a house because of this, and that is a lot of people's dreams. So on one hand, the argument can be that that is a good thing. On the other hand, though, we want to try to avoid a situation like we saw in 2008, where lenders were basically giving out loans to anyone. In 2008, lenders basically had no verification process. They didn't need to know what your income was. They didn't need to know what your credit score was. They just wanted you to be in a house. These became known as ninja loans. No income, no job, and no asset loans. And as we know, this eventually led to the collapse of the housing market in 2008. Housing prices dropped in some areas by 95%. That means if you had a house that was valued at $100,000, it would drop to around $5,000. And during that same time, the federal government took back control of Fannie Mae and Freddie Mac. When they were originally founded, they were under the United States government control, but eventually they were allowed to start doing their own thing. But in 2008, that completely stopped. And ever since, Fannie Mae and Freddie Mac have been under the United States government control. And it's important to note that many lenders have a verification process now, so it is very unlikely that we will see a situation like we did in 2008. In order to get a mortgage today, you have to go through a very lengthy process. You have to show proof of income, a decent credit score. You also have to put a certain amount down. But with Fannie Mae and Freddie Mac guaranteeing a certain amount of loans, well, this gives an incentive for lenders to require people to put even less down. I mean, why would they care how much you put down? Their money is guaranteed anyway. In addition, they can give out lower interest rates, which means more people are going to get more homes. And that might mean that the housing market is going to continue to be red hot into 2022 and beyond. The Federal Reserve has announced that they plan on increasing interest rates at least one time in 2022. If Fannie Mae and Freddie Mac say that they're going to guarantee more, that means that lenders may still continue to keep interest rates low, and they might not require people to put down that much for a down payment. Those things might end up completely balancing themselves out, and we might see a housing market that either only slightly rises, which would be normal, or we might see a housing market that continues to boom. It really all depends on how much the Federal Reserve decides to increase interest rates. If interest rates go way back up very quickly, then we will see a sharp drop off in the amount of people that are going to apply for a mortgage. If it's only a slight increase, then you'll see only a few people exit the housing market. But I want to give you one more thing to consider here. If lenders know that they can have all of their mortgages backed by the US government, well, then you'll see more lenders go into this Fannie Mae and Freddie Mac program. By the end of 2021, 66% of all mortgages were bought by Fannie Mae. That equated to over $11 trillion being pumped into the housing market, and more importantly, into banks and other financial institutions. Fannie Mae and Freddie Mac basically take these mortgages and repackage them into what's known as a mortgage-backed security. Essentially, a mortgage-backed security is an asset that investors can invest in. The security essentially pools a bunch of different mortgages together. Think of it like an ETF, but with mortgages. Investors invest in those mortgages, and that gives money to Fannie Mae and Freddie Mac. That gives Fannie Mae and Freddie Mac money to go out and buy more mortgages. But in 2008, a lot of people ended up not being able to afford the mortgages that they were given. So that meant that immediately the mortgage-backed securities lost money. And then the stock market ended up crashing because everybody was pulling their money out of the stock market. Mortgage-backed securities are typically seen as safe investments because people usually pay their mortgages. But what if they don't? If they don't, then that means their house is going to be in foreclosure. If their house is in foreclosure, that means they're not making payments on their mortgage. If they're not making payments on their mortgage, that means the stock market isn't getting any money either. And if the stock market isn't getting any money, then they can't invest in any mortgage-backed securities, which means Fannie Mae and Freddie Mac can't get any money either. And if Fannie Mae and Freddie Mac can't get any money either, then they can't buy any mortgages from lenders. That means overall, lenders are going to have to be a lot more strict about who they give a mortgage to. So it's kind of a slippery slope, and the article talks about this a lot. Should the federal government be owning so many mortgages? Because at the end of the day, if the federal government says that it guarantees a certain amount of loans, then it will. Even if it's not getting any investor money, it is still going to give that money back to lenders. However, that just might mean the Federal Reserve has to print even more money, which means more inflation. And it also raises the question about how much the government should actually back when it comes to mortgages. Should it be near $1 million? I mean, there are some markets in the country where, yeah, $1 million doesn't really get you that much house. However, is it really the federal government's responsibility to step this far into the housing market? Honestly, I think it is a slippery slope. Because at the end of the day, if lenders get a bit too greedy and they start giving out loans to people who really can't afford them, well, that's ultimately going to fall on the US federal government. And the US federal government is going to have to bail out a lot of banks or other financial institutions if they start to fail. This simply creates more greed, because if the government bails out companies like we saw in 2008, the companies didn't really learn anything. They're simply going to do this again because they know that they are too big to fail. And you might see investments on Wall Street continue to get riskier and riskier, at least when it comes to these mortgage-backed securities, because they know the federal government will step in. The federal government does not want people to fail, so even if it means inflation going through the roof, they will make sure that the United States economy does not completely fail. That means more money printing, and what it ultimately means is that these companies and Wall Street can pretty much get away with doing whatever they want. But the US federal government is also desperately trying to avoid a situation like we saw in 2008. And the Federal Reserve has even talked about how inflation is a bit higher than even they thought it would be by this point. So they're starting to cut things back. A lot of their stimulus programs have already been cut, and they plan on raising interest rates. Now, depending on what goes on in the housing market and with inflation, they may end up raising interest rates even more and even sooner. Some experts are saying that the government should eventually start weaning off of these loans, so they actually create policies that put them further away from the housing market. That would mean that a lot of these loans are less backed by the US federal government, and lenders have to be a little bit more strict. But it wouldn't be completely zero, and it wouldn't be completely 100%. It would be somewhere in the middle. Fannie Mae and Freddie Mac ultimately keep the housing market going because they allow a lot more people to get mortgages. For a lot of people, especially people who are tired of renting, that is a great thing. But it also creates kind of a financial mess that might end up biting us all in the back in the near to distant future. But now I want to hear from you on this issue. What do you think about Fannie Mae and Freddie Mac raising the amount that they will back from lenders? Is this a great idea, or will it ultimately lead to the housing market collapsing? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.